I was recently speaking with a logistics manager who specializes in the European route. He's usually the type of person who speaks in cold, hard numbers, shipping rates, container volumes, lead times. But this time, he told me about a specific conversation he had with a long-term partner in Stuttgart, the very heart of Germany's industrial machine. He described his partner's tone as uncharacteristically hushed. This was a man who, for 20 years, viewed the German economy as an unstoppable locomotive. He used to joke that even if the rest of the world caught a cold, Germany wouldn't even sneeze. But during their last call, the partner wasn't talking about new production lines or high-tech exports. Instead, he was fixated on a single screen. The latest PMI data showing a sudden, sharp contraction in manufacturing. He told my friend, "It feels like the engine has finally stalled and no one is coming to jumpstart it." What's fascinating is the disconnect. While many investors have been focused on a resilient U.S. economy and the Federal Reserve's cautious approach to interest rates, this quiet panic in the German industrial sector has created a massive invisible rift. My friend expected his partner to be worried about competition. Instead, the man was worried about survival. He pointed out that while the U.S. is still debating how slowly to pivot, the European Central Bank is being backed into a corner where they might have to slash rates far more aggressively just to keep the lights on. This isn't just a localized slump. That stalled engine in Stuttgart is the first sign of a widening scissors gap between U.S. and European monetary policy. It's a shift that's beginning to drag the euro down against the dollar, creating a volatile new reality for global trade. For anyone watching the markets, the question isn't just about whether Germany can recover, but how this sudden European weakness is about to rewrite the rules for exporters and investors halfway across the world.
That's a perfect encapsulation of what's happening. That story, the unstoppable engine suddenly stalling, it's really the defining macro signal of our time. It tells us that global policy paths are diverging radically.
Right, and that's what we're here to unpack. So what's the mission for this deep dive?
Our mission today is to connect that huge macro divergence, the German crisis forcing the ECB's hand and fueling all this currency volatility, to the immediate microeconomic survival strategies that global businesses need right now.
Okay, so we're talking about practical steps.
Exactly. Specifically, we're looking at how small and medium enterprises can stop just reacting to these currency swings and actually start capitalizing on them. How they can transform treasury management from, a simple back office function into a genuine competitive advantage.
So this is about protecting your business as this plays out.
It is. This deep dive is about the operational changes you need to make right now to protect your profit margins as the euro, as it continues to depreciate against the US dollar through 2026.
Okay, let's unpack that metaphor then, the stalled engine. Because on the surface, things look, global GDP is expected to grow by a solid 2.6% in both 2024 and 2025.
Right. Globally, there's growth.
And even the euro area is projected to manage positive growth. It's slow, sure, 0.7%, then 1.3%, but it's still growing. So what is it about Germany, the supposed backbone of the whole eurozone? That means it's forecasting a real GDP decline of 0.1%. This isn't just slow growth. This is going backward.
And that's the core of the issue. The persistent weakness in German economic development is the big red flag. And it's not coming from everywhere. It originates specifically from a decline in industrial production, in manufacturing.
So it's concentrated in that specific sector.
It is. And when you look at the comparative data, Germany is really decoupling from the global economic trend. The rest of the world is managing to absorb shocks and find a way to grow. But the German industrial sector is actually shrinking.
Which points to something deeper.
Much deeper. It tells you the issue is not merely cyclical. It's not something that will just bounce back when global demand picks up again. It's structural. The engine itself hasn't just paused. Some of the key components are failing.
And that structural weakness is what makes this a crisis for the whole eurozone, not just a problem for Berlin. So if we look deeper into what's holding back this recovery, it's a whole list of domestic policy failures and, investment deficits.
Precisely. Let's really detail those deep structural headwinds because they fundamentally erode Germany's ability to compete on a global scale. First, you have to consider infrastructure decay.
Crumbling roads and bridges.
Yes, but it's systemic. The data highlights that the modernity level of federal roads, waterways, and railways is actively declining. This means the core logistics network, the very arteries that pump German exports across Europe and the world, is degrading. It's all because of insufficient investment and maintenance.
But hold on, how does a crumbling road in Germany really impact, say, an SME in Hong Kong or a distributor in New York? Isn't that just a local problem?
You'd think so, but it creates this systemic inefficiency that translates directly into higher costs for everyone in the supply chain. Think about it. Modern industrial production relies on just-in-time delivery.
Right.
So if a key rail line or a federal road has a lower modernity level, it means more frequent unexpected delays, higher fuel consumption from congestion, a much higher risk of a complete breakdown in the transport network. All of this raises the implicit cost of every single export before it even leaves the German factory gate.
Making them less competitive.
It damages their competitiveness against rivals in Asia or the US, where logistics might be faster, cheaper, and more reliable.
And underlying this lack of investment seems to be this paralyzing political issue the research calls institutional inflexibility.
And that's where the policy problem really starts to bite. We're seeing a profound present bias in their politics.
A present bias. What does that mean?
It means policymakers consistently prioritize expenditures that benefit the current electorate. Short-term subsidies, immediate tax cuts, things that win votes now.
Instead of investing in the future.
Exactly. They're not prioritizing future-oriented investments like upgrading the energy grid or long-term education or, crucially, fixing those roads and railways we just talked about. Those things only yield returns years, maybe even decades down the line.
So that present bias starves the country of the money it needs for long-term modernization. And I've heard that even when the money is theoretically there, the bureaucracy just kills any momentum.
The layers of red tape are legendary. You have these bureaucratic obstacles and incredibly complicated, multi-layered permit processes that inhibit both public and private spending.
So a company might want to build a new factory.
Right, you could have a German company eager to build a state-of-the-art facility, but the decade it might take to navigate all the planning, environmental, and construction permits means that investment often just goes somewhere else, maybe to a country with a more streamlined system.
Yeah.
This lethargy prevents the essential capital investment needed to reboot that stalled engine.
And we can't ignore the domestic side of things, particularly the housing crisis. That has to act as a massive drag on labor mobility and efficiency.
It really does. House and rental prices have just soared over the last 15 years, especially in those productive urban areas like Berlin, Munich, and Hamburg.
Which is a factor you might not immediately connect to industrial output, but it's critical.
It's absolutely critical. The demand is being fueled by a rise in single-person households and, of course, strong population growth from immigration, which naturally concentrates in the cities where the high-value jobs are. But the supply side is completely paralyzed.
Why?
Insufficient land availability, and a real lack of construction activity. And that's made worse by that same bureaucratic inflexibility we just discussed.
The resulting price gap sounds staggering. There's a huge difference between what you pay for a new rental contract versus an existing one.
The gap is enormous. In major metropolitan areas, it can be as high as plus 24.7%. And that gap doesn't just hurt the wallets of the people living there, it actively distorts the entire labor market. If workers can't afford to move to where their skills are most needed, say from a cheaper small town to a big industrial city, the whole economy suffers from these massive efficiency losses.
So companies can't get the skilled labor they need.
Exactly. This lack of affordable housing, coupled with inadequate transport from surrounding regions, restricts the access of productive companies to the skilled labor they desperately need. It's a fundamental structural break on growth.
Okay, so we have crumbling infrastructure, a politically paralyzed investment climate, and a housing crisis that's choking off the labor supply. What does this whole laundry list of structural problems mean for the ECB and for global financial markets?
It means the downside risks for Germany's economic forecast are dangerously magnified. These are not issues that are going to disappear with one good quarter of export data.
They're baked in.
They're baked in. And if the German economy continues to flounder because of these deep-seated problems, it puts immense asymmetric pressure on the European Central Bank. They will be compelled to intervene.
Meaning cutting rates?
Potentially slashing rates far more aggressively than the Federal Reserve, just to try and prevent a deeper recession from spreading across the entire Eurozone. And that is what creates that scissors gap. The U.S. maintains a tight policy because its economy is resilient, while the ECB is being backed into a corner by the structural decline of its biggest member, and that signals continued euro depreciation.
Which brings us directly to the consequence of all this.
Yeah.
The German crisis forces the ECB's hand, which leads to massive currency volatility.
That divergence is the #1 engine of short-term currency risk right now. If you look at the immediate drivers, it's all about central bank policies. The interest rate decisions of the Fed versus the ECB are paramount.
Higher rates in the U.S. means a stronger dollar.
As long as the U.S. maintains higher rates, capital flows into dollar-denominated assets. That pushes the dollar up and the euro down. And this whole movement is amplified by geopolitical events, the uncertainty from the Russia-Ukraine war, U.S.-China tensions, and basic economic conditions like shifting trade balances. These things cause sudden, sharp movements in exchange rates that can happen literally overnight.
And it sounds like the long-term structural drivers mean this volatility isn't going away anytime soon.
Precisely. You have these huge secular trends like de-dollarization, the growing economic influence of Asia and China, where more and more transactions are happening in local currencies. Plus, the acceleration of digitalization in trade and the ongoing complex evolution of globalization itself. All these forces combine to make currency markets not just unpredictable, but genuinely dangerous for an unprepared SME.
And this environment creates severe, almost existential risks for those international SMEs. We're not just talking about a number on a screen. It's a direct threat that can out profit margins completely.
Oh, absolutely. If you're an exporter or an importer, it means a loss of competitiveness in your client pricing. You quote a price today, and if the exchange rate moves against you by just 3%, before you get paid or before you pay your supplier, that's 3% of your profit margin just gone.
And banks and investors notice that.
Immediately. This increased earnings volatility leads to a discount on your company valuation, which then limits your ability to get favorable financing for expansion or for inventory. It's a vicious cycle.
And you're fighting on two fronts. You have the logistical uncertainty from supply chain disruptions, and then you add this currency risk on top.
The volatility is compounded. You're fighting the clock on delivery and fighting the market on price at the same time, which is why the very first line of defense has to be securing financial efficiency at home. And that leads us to the fundamental treasury challenge that's made worse by this US-Europe rate gap, the idle cash problem.
This is that painful disconnect you mentioned earlier. Most SMEs just park their operational cash in a traditional bank deposit, which often offers an interest rate close to zero.
Or near zero, yeah. Nominal rates. Yet central bank rates, driven by the fight against inflation, have been significantly high.
So what's the real cost here?
Think about the pure opportunity cost. In 2024, the USD cash rate hit a recent high of 5.5%, and the EUR cash rate peaked at 4%. If you just ignore this difference and let $1 million of your operational reserves sit in a 0.5% yield account for 1 year, you are losing approximately $50,000 to inflation and neglect.
$50,000. That's a salary.
That's $50,000 that could hire a new salesperson, cover a marketing campaign, or purchase essential new equipment. That scale of missed opportunity is what turns the idle cash problem from a minor oversight into a critical financial drain.
Because you need the cash instantly, but the interest you get paid is negligible.
Exactly. So companies need cutting-edge strategies that allow them to secure market rate interest on 100% of that surplus cash, while, and this is the key, simultaneously maintaining the flexibility to use it immediately for operational needs. That necessity is the starting point for best-in-class treasury management today.
So we have this massive volatile scissors gap driven by Germany's structural decay, forcing the ECB to potentially lower rates and fuel euro depreciation. If that's the threat, where does an SME even start the defense?
The defense always starts at home. It starts by making sure every single dollar on your balance sheet is actively working for you. And that begins with that idle cash.
Okay, so the objective is clear. Secure market rate interest on all your surplus cash, but you have to maintain flexibility. You can't have the money locked up in a time deposit if you need it tomorrow to pay a sudden customs bill or something.
This is where we have to move beyond just the standard checking account. First, let's talk about flexible deposits. These are designed specifically for operational needs. The key feature is that they allow cash withdrawal at any time with minimal impact on the interest you've earned.
And security is paramount.
Absolutely. Crucially, these solutions must be backed by highly liquid, high-quality collateral to ensure security and immediate access.
So what does that collateral actually look like in practice?
The two main types are familiar, but they're used in a very strategic way here. The first one is straightforward. U.S. Treasury bills or T-bills.
Government bonds.
Short-term government bonds. They're often used as the gold standard for liquidity because they are ultra easy to buy and sell, which provides assurance of quick access to your cash at very low risk.
Okay, that makes sense. The second mechanism sounds a bit more intricate, though. Treasury swaps, or currency swaps, used for cash management.
Right. Think of it this way. Instead of leaving your USD idle at the bank earning nothing, you are essentially loaning out that high-yield USD cash. You deposit the cash with a major regulated exchange, like the CME or Eurex, and in return, the exchange gives you highly stable physical collateral.
In what form?
In a lower-yielding foreign currency, like Japanese yen or Swiss franc.
Okay, but if they're giving me yen or francs, how do I avoid the currency risk on that collateral? Isn't that just trading one problem for another?
That's the genius of the swap structure. The exchange rate for that collateral currency is locked in for the entire duration of the swap, so the currency risk is instantly hedged away. At maturity, the foreign currency collateral is returned, and you receive your original USD deposit amount back, plus the prevailing market interest rate. So you've leveraged global liquidity, generated interest at the market rate, and completely eliminated currency risk through that collateral lock-in.
So you get security and the market yield. You solve the idle cash problem. Okay, now let's move to the money you know you won't need for, say, 3 to 6 months. The less liquid but higher yield options, the fixed deposits.
Here we can leverage the banking relationship strategically. One option is a fixed deposit backed by bank bonds. So instead of just accepting a standard low deposit rate, the SME actually buys a bond from the bank directly.
You're lending to the bank.
Essentially, yes. You're lending money to the bank via a more direct instrument, which offers a higher interest rate than a regular deposit, while the level of risk remains basically the same as just holding cash at that institution.
And then there are asset-backed deposits, specifically those backed by shares. This sounds like a powerful way for larger SMEs to get access to the institutional money market.
It is. This solution provides direct access to the money market on regulated exchanges like NASDAQ. By providing liquidity to the exchange and using shares listed on that exchange as collateral, these deposits can deliver significantly higher interest rates than traditional bank deposits.
What kind of rates are we talking about?
For context, as of late 2024, a 3-month USD deposit of this type could yield a cutting-edge annualized rate of around 6.00%.
That's a huge difference from near zero.
It's a game changer. Now, they do require substantial minimum deposit, often $500,000 or more, and they're designed to be held until maturity. But they offer a very high yield with virtually no counterparty risk because the whole transaction happens on a regulated, highly monitored exchange.
This is the kind of practical application we need to dig into. Let's focus on structured products, like dual currency deposits or DCDs. These are complex, but you said they offer the highest potential yield in exchange for taking on a very specific, defined currency risk.
DCDs are short-term deposits, typically 1 or 2 months. Their unique feature is that they have an embedded option. They can be automatically converted into a different currency if the exchange rate at maturity is either above or below a predetermined conversion strike rate.
You used the phrase quiet panic in the opening narrative. This sounds a bit like a financial gamble. Why would an SME intentionally take on conversion risk for their operational cash?
The insight here is strategic, not speculative. The SME is often already exposed to that specific currency fluctuation because of their future operational needs. The DCD simply monetizes that existing risk exposure.
So you get paid to take a risk you already have.
Precisely. They offer a significantly higher yield. We've seen examples of a net annualized rate of 9% as compensation for taking on that conversion risk. The strategic intent is to align a high-yield instrument with an unavoidable future currency requirement.
Can you give us a concrete application?
Sure. Take an SME with a large amount of US dollars who knows they have upcoming payments in Chinese renminbi or RMB in the next quarter. They can place their USD in a USD RMB DCD.
Okay.
If the USD RMB rate at maturity is above the preset conversion strike, the USD deposit is automatically converted into RMB. If it's below the strike, they get their USD back. But crucially, regardless of the outcome, that 9% interest is paid.
So what's the risk?
The risk is that the conversion happens at a rate that's slightly less favorable than the spot market at that exact moment. But the company has secured a massive interest rate to compensate for that exposure. They're essentially getting paid 9% to manage their existing risk strategically.
That makes the difference. It's not about taking a new risk. It's about optimizing an existing exposure. Okay, moving up the organizational scale. What happens when an SME especially in complex hubs like Hong Kong or Singapore, has multiple legal entities. They need cash pooling strategies.
Cash pooling is absolutely essential for efficiency at that scale. The benefits are substantial. You get optimized interest earnings because surplus funds are invested centrally, enhanced liquidity and risk management through unified control, much better cash visibility across the entire group, and the critical benefit of reduced borrowing costs.
How does that work? Reducing borrowing costs.
By offsetting positive and negative balances within the organization. Instead of one subsidiary borrowing externally at 5% while another has cash sitting in an account earning 0, you use the internal cash first.
And different pooling structures address different regulatory needs, right?
Yes, and the structure matters a lot. Physical pooling is the highest level of control. Funds are physically transferred or swept into a central master account, usually daily. This is great for liquidity, but it can be administratively complex and might have cross-border tax implications.
And the alternative?
The alternative is notional pooling. With notional pooling, the balances remain legally and physically in their separate subsidiary accounts, but they are combined only for the purpose of calculating interest.
Why would a company use notional pooling if the physical kind offers better control?
The primary reason is regulatory constraints. Many jurisdictions have rules that make physical cash sweeping difficult or impossible. Things like restrictions on intercompany lending or specific requirements in regulated industries like finance or insurance. Notional pooling allows the group to get the benefit of interest optimization without violating local rules or incurring unfavorable tax treatment.
And there's a middle ground, I assume.
Yes. Finally, there's a hybrid pooling structure, which combines the other two. It offers tailored flexibility. You might physically sweep cash from highly controlled entities while using notional pooling for accounts in more sensitive regulatory environments. It lets you get the optimal balance of efficiency and compliance across the entire organization.
Okay, so efficient cash management deals with the opportunity cost of idle funds. Now we have to tackle the core threat generated by that US-Euro policy scissors gap, the currency risk itself. We need a structured way of identifying currency risk.
The moment of critical risk is when a company sets its selling price in one currency, let's say US dollars, but its production or supplier costs are denominated in another, like Chinese renminbi or euros. That mismatch is the exposure that you absolutely have to manage.
Let's distinguish the two types of FX risk. There's the direct FX risk, which is the obvious one.
Direct risk is straightforward. If you pay your suppliers in RMB, but you receive client payments in USD, any currency fluctuation directly hits your profit margins. If the RMB strengthens, your costs rise relative to your USD revenue, and your expected profit shrinks. Most people understand this.
But the truly dangerous one, the hidden cost, is the indirect FX risk. This one exists even if a company thinks they're safe because they pay their suppliers in their own base currency, like USD.
This is the crucial insight that so often sinks unprepared SMEs. Many business owners mistakenly believe that if they pay and receive in the same currency, they have no FX risk. That assumption is completely false.
How so?
Think about it. If the RMB strengthens against the USD, your Chinese supplier knows their local costs, their labor, their materials, their electricity, all of that is rising relative to the US dollars you're paying them. So to maintain their own local profit margin, what are they going to do?
They'll raise their prices.
They will simply adjust their USD prices higher in their next invoice to you.
So the SME is implicitly exposed to the RMB variation, even though the contract is in USD. You're basically paying for your supplier's currency risk.
Precisely. And many suppliers will price in a hefty currency buffer, it's often 5% or even more, when they invoice in the client's currency just to cover that potential movement over the contract period. The SME pays that buffer as an invisible extra cost.
Which brings us to the hedging imperative. If this indirect risk is already baked into the price, why must an SME take on the complexity of systematic hedging?
The reasons go way beyond just simple loss prevention. There are 3 really powerful arguments. 1, protect your core margin from volatility. 2, actively increase your profit margin through strategic risk management. And 3, improve your corporate governance, which smooths out earnings volatility and maximizes your firm's valuation.
Let's focus on that second point because it sounds counterintuitive. How does hedging, which involves costs, actually increase profitability?
This is the strategy of systematically pocketing the currency buffer. This is probably the biggest single financial opportunity for most international SMEs. Since companies that don't hedge have that 5% currency safety buffer baked into their price, when you implement a systematic hedging strategy, you lock in a predictable exchange rate for your costs. The risk is now eliminated.
And since the risk is gone, that buffer becomes unnecessary.
Exactly. And the company then gains a powerful strategic choice. They can keep that 5% buffer as pure extra profit margin, significantly improving their financial health, or they can remove the buffer and lower their selling prices by 5%, which dramatically improves their competitiveness in the global market. Effective hedging transforms that 5% invisible cost into either a significant revenue driver or a powerful market advantage.
So a company commits to hedging to pocket that 5% buffer. They need the right tools. We've identified three main categories, offering different balances of certainty versus flexibility. Let's start with futures or forwards contracts, which provide the maximum certainty.
A forward contract is simply an agreement. You agree to exchange a specific amount of one currency for another at a fixed exchange rate on a fixed maturity date in the future. So if the current spot rate is, say, 7.2 RMB per USD, you might lock in 7.0 for 6 months from now.
The key word here is obligation, right?
That's the one. The buyer has a total obligation to complete that transaction at the agreed rate, no matter if the market moves for or against them. And because it's a guaranteed commitment, it usually requires a margin deposit, a kind of security deposit, to guarantee the contract. But the benefit is immense. Total predictability. It completely protects your profit margins.
Okay, next up, options contracts. These offer flexibility, but there's an upfront cost.
An options contract is basically financial insurance. It gives the buyer the right, but not the obligation, to exchange currency at a specified strike price on or by a certain date.
So if the market moves in your favor,
you just let the option expire and use the better spot rate. If the market moves unfavorably, you exercise the option and secure your protected rate.
So you're paying a premium to protect against the downside, but you keep the ability to benefit from the upside.
That's the core trade-off. It requires an upfront premium payment, which is the cost of that insurance. But a key advantage over forwards is that you generally don't need a margin deposit. Options are really ideal for scenarios where the exact timing or the volume of a future transaction is a bit uncertain, or if management really wants to participate in a favorable market swing.
Finally, let's talk about collar contracts. These offer a kind of defined safety zone, and you said often with zero upfront cost.
The collar is a really elegant hybrid. It's an option strategy that simultaneously sets both a minimum exchange rate, which we call the floor, and a maximum, or a cap. It defines a band, a safety zone, within which your final conversion rate has to fall.
Could you use a metaphor to explain that? It seems a bit complex.
Sure. Think of it like this. A standard option is like buying insurance for your car. A collar is like insuring your car against a total wreck. But in return, you agree not to claim any lottery winnings you might happen to find inside the car.
Huh. Okay. I get it.
You sacrifice the extreme upside benefit for guaranteed protection against the extreme downside, all while minimizing the cost.
And how is it structured to get that zero premium? That seems to be the killer feature.
It involves combining two options. You buy a put option to set the floor, protecting you. And at the same time, you sell a call option to set the cap, which limits your potential upside. The money you get from selling the call option is used to pay for the protective put option. This allows collars to often be structured as a zero premium option, making them incredibly appealing for budget-conscious SMEs who need robust protection without sacrificing immediate cash for an upfront fee.
Okay, to make all of this really actionable, let's bring it together with a real-world scenario. You mentioned the ABC company, a Hong Kong OEM. This case seems to perfectly illustrate how ignoring these risks costs a business millions, and how applying these solutions creates a massive competitive edge.
It does. ABC sold its products primarily in USD, but almost all of their manufacturing costs were in RMB. And their initial treasury setup was typical of so many SMEs. They paid their Chinese supplier in USD because they believed this eliminated FX risk and all the complexity of currency management.
The classic and very costly mistake of ignoring the indirect risk.
Exactly. By paying in USD, ABC was implicitly exposed to the RMB risk, and they were paying a higher cost because their supplier was pricing in that currency buffer, a conservative 5%, to cover their own currency risk. That 5% was ABC's invisible, unnecessary cost of doing business.
So the supplier was literally charging them extra for the convenience of receiving US dollars. What was the core solution that was implemented?
It required a real commitment from management. First, ABC switched its policy to paying its Chinese supplier directly in RMB. This involved a negotiation, of course, where ABC showed its commitment to systematic hedging, promising the supplier a stable stream of RMB payments. That allowed the supplier to immediately drop that 5% currency buffer.
And second?
Second, ABC implemented a systematic FX hedging program, primarily using futures contracts, to manage the new RMB exposure they had taken on, but in a controlled, cost-effective way.
So beyond just securing that 5% buffer as extra profit, what was the immediate impact on their transaction costs?
They gained significant cost savings. They eliminated the high currency conversion fees their bank had been charging them. ABC was paying 0.40% of the converted amount to their bank for every single FX transaction. The new hedging program drastically reduced that transactional cost, moving them from a high-fee retail structure to a cost-effective institutional one.
And now let's go back to the idle cash problem. This company was sitting on assets that were just losing value every day relative to the market.
They had an average of $5 million in idle cash on their balance sheet, earning next to nothing from their traditional bank deposits. By implementing a flexible deposit solution, which at that time was yielding 5.5% annualized, they secured an extra financial gain of $275,000 per year.
And that's not a one-time gain.
That's pure, recurring, non-operational profit added directly to the bottom line, simply by optimizing their liquidity management.
And for a company like ABC with 5 subsidiaries, cash pooling provided that final structural optimization.
It was critical for their overall financial health. These 5 entities across Hong Kong and Singapore were all holding substantial unremunerated cash while simultaneously borrowing externally at various, often unfavorable interest rates. By implementing cash pooling, they consolidated their liquidity.
Which means no more expensive external loans.
It minimized their borrowing costs by offsetting internal positive and negative balances. And, critically, it increased visibility for the CFO on the group's true cash position at any given moment.
So if we quantify the total result of this whole treasury overhaul, we are talking about a fundamental shift in the company's entire profit profile.
Absolutely. By putting these best practices in place, eliminating the currency buffer, utilizing market rate deposits, streamlining liquidity via cash pooling, ABC secured an effective increase in their profit margin of 5% from the buffer, plus an extra 5.5% on their idle cash. This transition turned their finance department from a cost center into a strategic source of revenue and stability.
The current global environment, with all its supply chain uncertainties, conflict, geopolitical tensions, logistical bottlenecks, it means that traditional, rigid hedging contracts just aren't enough anymore. The solution itself has to be adaptable.
That's right. So many companies that relied on old-school bank hedging solutions found themselves trapped by inflexible contracts when the pandemic hit or when shipping routes changed overnight. Renegotiation was costly and often came with massive fees.
So what are the 2 cutting-edge features that a modern hedging solution needs to have today?
The first one is absolutely key feature 1, flexible dates. Supply chain timelines are no longer set in stone. A client might postpone a large payment by 3 months, or a supplier might require an earlier deposit to secure scarce raw materials. Your hedging program has to allow the conversion schedule to be changed without penalties or huge recalculation fees.
Can you give a specific example of that flexibility in action?
Certainly. We saw a Hong Kong client who had hedged their yearly RMB payments against the dollar at a fixed forward rate. But due to disruptions from a global conflict, their primary European client rescheduled a large chunk of those payments into the next year.
Which would normally break the hedge.
With a traditional contract, yes. But with the flexible solution, they were able to adjust the hedge, shift the maturity date, and maintain the exact same fixed conversion rate, all at no extra cost. That flexibility protects the economic intent of the hedge even when the operational timeline shifts radically.
And the second key feature has to address changes in volume. Key feature 2, flexible amounts.
Yes. If a client temporarily reduces an order because of soft demand, or a supplier unexpectedly raises prices, the amount of currency you need changes. The hedging program must give the SME the flexibility to adjust those conversion amounts. You should look for programs that allow for partial cancellation of the hedge at no extra cost if the conversions are no longer needed. This stops the company from being forced to buy or sell currency it no longer needs at an outdated fixed rate.
Finally, for the CFO or the finance department, there's the crucial issue of hedge accounting. This sounds highly technical, but why is it so essential for treasury management?
It's necessary to resolve a massive, visible accounting mismatch that's created by regulatory rules. When SMEs use derivatives like forwards and options, standard accounting requires these instruments to be reported at their fair value or mark-to-market.
And this causes P&L fluctuations.
Exactly. It results in mark-to-market gains or losses being recorded in the income statement, causing these wild profit and loss swings that don't reflect the actual economics of the hedge, which is simply to protect a future cash flow.
So the company's actually stable, but its quarterly income statement looks incredibly volatile because of these paper gains and losses from the hedge.
Precisely. And that's where hedge accounting provides the solution. By referencing standards like HKFRS 9, which is critical for companies operating out of Asia, the company gets a mechanism to move those temporary fluctuations. You move those paper gains and losses out of the income statement and into a special reserve section on the balance sheet called Other Comprehensive Income, or OCI. This smooths out the income statement volatility and provides a much clearer, more accurate picture of the economic effectiveness of the hedge. So we just summarize, there are really 4 pillars that define optimal multi-currency treasury management. First, you have to rigorously understand the macro drivers, especially this US-euro divergence. Second, you have to identify and measure all your currency risks, including those hidden indirect threats. Third, eliminate that risk by systematically hedging with flexible instruments. And fourth, implement efficient cash management to turn all that idle liquidity into a new profit center for the business.
So that stall engine in Stuttgart and the resulting widening monetary scissors gap are fundamentally changing the reality for every single international business. The volatility means that taking proactive control of your treasury operations, moving your idle cash out of 0% accounts, and systematically hedging against that invisible 5% indirect risk is no longer an optional luxury. It transforms treasury management from a cost function into a strategic enabler for growth. It secures profit margins that were previously vulnerable, and it substantially increases the bottom line. For any company sourcing products internationally, the most immediate and profound action you can take is to quantify the hidden currency buffer you are currently paying your suppliers, because that 5% is your company's new guaranteed competitive advantage, and it's just waiting to be claimed.